$22 trillion in losses, the worst financial collapse since 1929.
Give me the latest figures. Sell it now. Buy 20,000, quickly.
By 2006, 1 in 3 mortgages issued in America was subprime or had no documentation at all. 17% of that year's home purchases. In April 2004, in a basement meeting at the Federal Reserve, the 5 largest investment banks were exempted from the net capital rule, a key safeguard against excessive risk. Those risky mortgages were bundled into bonds, sold to investors worldwide. The danger was hidden inside the complexity nobody fully understood. The foundation was cracking. One man saw it coming, years before anyone else. May 19th, 2005. A hedge fund manager makes a $60 million bet against subprime mortgage bonds, the first of its kind. Banks called it free money. I am educating the experts here, he said. They sold him insurance against their own mortgage bonds. Certain housing, a collapse was impossible. June 2007. The first real cracks appear. Bear Stearns bails out 2 hedge funds with $20 billion of exposure to subprime mortgage bonds. July 31st, 2007. The funds are liquidated anyway. They could not be saved. August 9th, 2007. BNP Paribas freezes withdrawals, citing a complete evaporation of liquidity. Banks had stopped trusting each other. The warning had been there for 2 years. The world was about to find out how loud the alarm really was. September 15th, 2008. Lehman Brothers files for bankruptcy, the largest bankruptcy in American history. Three days earlier, the Treasury Secretary and the Fed Chairman had warned Congress directly, if we don't do this, we may not have an economy on Monday.
If we don't do this, we may not have an economy on Monday.
Washington Mutual collapsed days later. $16.7 billion withdrawn in 10 days. A full-scale bank run. Congress was asked for $700 billion. The House voted it down, 225 to 208. The system was on the edge. What happened next would cost taxpayers trillions.
Sell everything now! Get me out of this position! It's crashing, we need to unload!
The government stepped in. $180 billion in loans to AIG alone. Of that money, $12.9 billion flowed directly to Goldman Sachs. Counterparty payments funded by taxpayers. Congress voted again. This time, TARP passed. $700 billion, the Troubled Asset Relief Program. By June 2009, after repaying its TARP funds, Goldman Sachs set aside $11.4 billion in bonuses. 953 employees received $1 million or more. The system was saved. But who had already profited from its collapse?
But who had already profited from its collapse?
Vindicated. The bet against subprime mortgages had paid off exactly as predicted. $100 million in personal profit. More than $700 million for his investors. Important context. He liquidated his positions by April 2008.
Did not benefit
Before
from the
TARP
taxpayer
even
bailouts.
existed. He did not benefit from the taxpayer bailouts.
Did not benefit from taxpayer bailouts.
In a 2010 New York Times op-ed, he made his own argument. Anyone who studied the markets carefully in 2003, 2004, and 2005 could have recognized the growing risk. He faulted regulators for failing to listen. One man profited from foresight. Others profited from something far more troubling. A second hedge fund manager made nearly $5 billion. By some estimates, though figures vary across sources. He selected 90 mortgage bonds he believed were most likely to fail and paid Goldman Sachs roughly $15 million to help structure the deal. His profit, approximately $1 billion. The losses fell on others: IKB, Deutsche Industriebank, ACA, ABN AMRO, and the Royal Bank of Scotland. IKB alone lost $150 million.
IKB alone lost $150 million. Affected institutions include IKB, ACA, ABN AMRO, and RBS.
In 2010, the SEC settled with Goldman Sachs for $550 million. Goldman acknowledged its marketing materials had been incomplete. Meanwhile, an elderly investor, known for patience, invested $5 billion in Goldman Sachs preferred stock. At the height of the panic. Be fearful when others are greedy, he said. Profit came in many forms. Accountability would prove far rarer. 8.7 million jobs were lost in the United States alone. Only one banker served jail time, 30 months, returning $24.6 million in compensation. On August 9, 2012, the Department of Justice announced that no charges would be filed against Goldman Sachs or its employees. To be fair, proving criminal intent in genuinely complex financial cases is difficult. That counterpoint deserves acknowledgement too. Two Americas, one crisis, empty homes on one side, record bonuses on the other hand. Does this pattern still repeat today? June 2026. The pattern returns. A single company completed the largest IPO in history. $1.77 trillion in target valuation, raising $75 billion. Within days, approximately $400 billion was wiped from its value. A broader tech sell-off erased $600 to $680 billion more. Bitcoin fell from $62,000 to below $60,000. Gold dropped 3.5%. It was a real, measurable correction. triggered by a hawkish Federal Reserve, disappointing earnings, and a massive new listing draining liquidity from the rest of the market. History doesn't repeat exactly, but the underlying pattern, concentrated risk, hidden behind complexity, tested by a single shock, is the same pattern this entire investigation has traced from 2008 to today.